Now listen, if you are new to Forex trading and you are tired of losing, this video is for you. I'm going to show you the one strategy that I recommend for beginner traders. And this strategy actually works and doesn't rely on hype or indicators. So stick with me and I will show you step by step how to actually use it. So when I first started trading, I think that was in lockdown, I was working at a petrol station. I had no idea what I was doing. I was chasing every shiny object. I was chasing every shiny strategy that I could find online. Every week I used to have a new system that I could try. And guess what? That cost me a lot because I ended up losing more than I could actually make. I wasted so much time chasing shortcuts and I lost constantly. But then I later on realized that the problem wasn't the market, or the market wasn't even against me. I was the problem. And then I discovered something that changed my whole trading, and that is simplicity beats complexity. I found a simple trend following strategy that actually worked, that even taught me lessons every beginner needs: patience, discipline, and how to read the market without getting overwhelmed. Alright, let's be real. Most beginner strategies fail, and that is the reality. And it's not because the market is unfair, no. It's because beginners make the same mistakes over and over again and they don't even learn from them. So let's see the beginner mistakes that they do. Now the first mistake is too complicated. Now beginners often think more indicators is equal to better strategy. They add moving averages, RSI indicators, or even Fibonacci or MACD. By the time they start trading, they have like many things on the screen, many indicators on the screen that even lead to disorganization and even confusion. Now the lesson is that complexity kills consistency. A simple strategy that you can repeat consistently will beat that one that will lead you to confusion. Now the second thing that makes beginner strategies fail is ignoring risk management. Beginners think that they will get that one holy grail strategy and they will risk everything on it, and in that process, that is where they fail. So if you can master risk management, have a risk plan in place, risk a certain portion of your account, don't jump into everything randomly. The lesson that you need to take is that risk management isn't optional. Risk management is non-negotiable. It is your ticket to survival in the long run. And then the third reason is that beginner traders have no patience. They chase trades. Every time traders hit stop loss, it's not even beginner traders, even us traders, every time we hit stop loss, emotions come in and they force us to chase random trades that are not even meeting our criteria. And the moment you do that, you are putting yourself into high risk of losing, because that is when emotions will take over. That is when you will end up panicking, taking random trades. And the lesson that I want you to take away is that let the market come to you. Let the market give you the opportunity, and when it gives you the opportunity, don't over risk, because even the good setups can fail. So stick to the plan, be patient, and don't chase random trades. Alright, now I'm going to show you the exact strategy that I recommend for you beginner traders, and this works whether you're a beginner trader or not. And trust me, it is simple, repeatable, and it doesn't rely on any indicator or fancy indicators. So I want you to always look at the higher time frame first. Are we bullish or are we bearish? And that is the 1 hour time frame or the 4 hour time frame. Remember, in an uptrend market, price is creating higher highs and higher lows, higher highs and higher lows. If it is a downtrend market, price is creating lower lows and lower highs, lower lows and lower highs. Please, don't just guess the trend. See with your naked eyes the price action that the market is showing you. Now, once you identify the market direction, wait for pullbacks. Don't chase price. Let it retrace into your order block, or maybe your fair value gap, or your support and resistance level. Wait for it to reach that level, and then you can be able to execute the trade, right? So I want you to use a simple candlestick pattern to confirm your entry opportunity. If price approaches your level, your entry point, now ask yourself, how am I going to take the trade now? Am I supposed to wait for an engulfing candle? Will it be a doji candle? Those confirmation entries are simple, and they guide you and they give you confidence. The first step is don't forget to set a stop loss and a target. You won't catch the whole move, and I wouldn't want you to lose your whole account on just one trade. Set a stop loss because even the best strategy can fail sometimes. So set a stop loss which is realistic, because with proper risk management, you know that you're risking maybe 10 pips to make 30 pips, or $10 to make $30, and that is realistic. So the moment you set that, you won't have issues with the market.
A stop loss is going to help you be able to know where you're going to exit your trade if at all the trade goes against you. So you should always put your stop loss just slightly above the order block like this. Or if it is an uptrend market, now in an uptrend market, remember the market is moving higher highs, higher lows. It is moving higher highs, higher lows, higher highs, higher lows. So you as a trader, what you're supposed to do is look for lows. Don't enter immediately. Wait for price to do what? Wait for price to come back to these points of interest. Wait for price to come back a little bit lower in these areas. Because when it comes back to these areas, you will be confident enough to say that now, as a trader, what I'm supposed to do is take the trade when price comes back to this level like this. Take the trade, enter the buy when price approaches this level like this. So you are not only trading based of confidence because you know your setup, you know how your price approaches, you know how you are supposed to enter your market, you have a strict plan that you're following. A stop loss is supposed to be a non-negotiable because the moment it comes and the moment you use it profitably, you will stand a high chance of getting quality trades. Now, this is just a sketch. If we come here to look on these example charts, first of all, we have said that identify the structure, be able to see what is the market doing, where is it heading. So, first of all, we can clearly see that this is a low and this is a what and this is a high. Price broke through this high like this, and that clearly shows you that this is a BOS. This is a BOS, and that is a breakout structure. So when price breaks structure now, we have said that price is not going to move in a straight line. It is always going to come back, at least make a pullback into your point of interest, into your area. We have a good candle here that we could possibly wait for price to come back to, especially when we have a fair value gap in it. So a fair value gap is this last red candle, this gap here that is always going to happen in the lower low or in the higher low area, especially in a downtrend market or an uptrend market. So our entry model, if you zoom in well, we have this clear thing. We have these three candles that have momentum. This one, and then if I clone this, we have also this one that is coming in here, and then we also have this like this. So we have three consecutive candles, and we could have taken this trade based of this thing called a fair value gap, because the last gap that has been left there, you can clearly see that price came back and tried to fill it inside here. To come back to your points of interest, it can be in a higher low. You see, it is not moving in a straight line. The market has to pull back. And in that process, that is why we are supposed to look for our higher low area. And in that process, now we have a higher low that we are supposed to take a trade from, right? So since now we know this is the higher low, our tool that is going to help us trade is this long position tool, because it is an uptrend tool. So we are going to take our trade based off this candle. This is a hammer candle which shows momentum, and then you will put your stop loss just slightly below this level, slightly below that higher low area. So that means that you will be able to get a good trade with a realistic risk to reward ratio, let's say for example of 3. And that is how you can clearly take a good trade that is based off a plan that is quality, that is quantity, right?
Alright, so let's wrap it up. That is the simple three-step trading strategy that you can follow, and trust me, if you repeat it over time, it will work. It won't work overnight, it will work as you consistently compound your profits. And that was it for this video. If you ever need a one-on-one coaching where I go in details to explain to you why, how, and when to take that trade, please, there is a link in the description for my one-on-one mentorship, and trust me, it will be worth it if at all you are a struggling trader. So if you found this video helpful, hit that subscribe button. You can even tell me about it in the comment section. I'll be reading the comments, and see you in the next one.